It's Q2. Let's kick it off. Had a lot of chart alarms going off this morning. Some big news overnight with oil. Looks like we have Saudi Arabia announcing some cuts. So I'm looking at ExxonMobil, oil prices, USO, everything jumping up here with some pretty big gaps. So we'll take a look at that. Happy Q2, everybody. Let's get started. We understand there's risk in trading. Please and always use trade capital only. Do not trade with money you cannot afford to lose. Whether you're trading stocks, options, futures, forex, cryptos, you know the deal. Social media, make sure it's the real me. YouTube.com/Chris Pulver. And then all my handles out there, Facebook, Real Chris Pulver, Instagram, Twitter, Real Chris Pulver. Make sure it's me. I'm not sending you messages. I'll reply to your messages if you message me. Make sure it's the real me, of course. But anything that comes, from me directly, looks like me, it's not me. I'm just telling you, like, double check the handles. If there's underscores, numbers, letters, if my name is spelled incorrectly, that's not me. So just get all those clowns and scammers kicked off, right? Okay, let's get into the charts. XOM, we're trading at 114. Look at oil. Oil's jumping up towards $80+. We had a big gap. Now we're talking about a pretty substantial jump here. From the close of last week, we are up. Currently, we had a little bit of a fade, but we're back about 5.91% off of last week's close on Friday. So we're getting a big jump on oil. Take a look at USO, stock that comes very close to mimicking the price of oil. We had a gap here. There's a 66.52 close to a gap of around $70. Again, pretty substantial. What's interesting is today in Equities on Demand, we're going to take a look at these trades. Reason why is a lot of our credit spreads we have, $66, right? $70 out to May. As we're going into Q2, maybe we have this little commodity-based push. Is oil going to lead the way for things like copper? Is it going to lead the way for things like these diversified ETFs that are energy, oil, gas related? Possibly, maybe. That'd be things like DBB. Is this going up? We're at 2014. DBC is another one. FTGC, that had a nice gap, so we're at 23.76, gapped up to 24.18. FTGC is another one. We gapped up a little bit as well. So we are getting some pretty big commodity-based gaps on the talk of oil cuts. And we've been looking at U.S. oil to head back up towards this yearly pivot around $94. Talking about the Fed, I saw something this morning that Fed Speaker Bullard is looking for, the Fed needs to stay at or above 5% in order to tackle inflation. We'll look at the CME Watch tool really quickly. Some really important stuff to share this week as well. I am going to be heading out tomorrow morning to Augusta, Georgia. If anybody's a golf fan, you know what's going on this week, the Masters, Thursday through Sunday. So I'm going for the first time. I've never been to Augusta. I've been a PGA member since 2008, and I've never gone. So I have complimentary access, fortunately, with my PGA membership. I'm going to go soak in some practice rounds, a par 3 tournament tomorrow, and be there Thursday, Friday to catch first few rounds. So that being said, there's some schedule changes this week with the trading rooms. So I'll make sure I communicate that today, as well as in Telegram in the trading rooms, because it'll be a Telegram week and video only week and no live sessions. But we'll talk about that in just a little bit. So let me get logged into YouTube, say hi to everybody, and take a look at the FedWatch tool while we're on this. So right now you're looking at a pause going into the May rate decision. So this has jumped up last week. I'm pretty sure this was 50-50. So we had about a 50% probability we'd stay. And this is now a 61% probability that the Fed is going to raise rates in May. So here we go again. The Fed kind of changing the market's expectations and what's going to get priced in. We'll find out. We're live right now, so let me click on this. Say good morning, everybody. All right, Chris in the house. Good morning. David, good morning. Catherine, good morning. Gary, Don, Robert, what's up? What's up, everybody? Good morning. Good morning. Happy Monday. Happy Monday. And happy Q2 kickoff. All right, nice to see everybody. Okay, so looking like we might see a rate hike coming in May. So we have some runway. By the way, there's nothing real vocal from the Fed in April. This week it's a shortened trading week. We have Good Friday with Easter coming up this weekend. U.S. markets are closed on Friday as far as the stock market goes, but Forex will continue to trade. Here's the Forex Factory calendar. We had Swiss CPI that came in better than expected, so that's probably a good thing. The PMI numbers came in. It's actually 10 o'clock. That's at the top of the hour. Let's go to this week. I know this week We have CAD employment on Thursday. We have Friday non-farm payroll. Even though Wall Street is closed, we have the Forex market open. We also have an RBA rate decision and an RBNZ rate decision on Tuesday. So the RBA, here is your expected rate hike. This was different than last week. We had to look at two separate calendars. This was last week. This said 3.6. And now it says 3.85. So it looks like the market is expecting a jump from the RBA going into Tuesday's trading. This is actually 12:30 a.m. So this is midnight, just after midnight Eastern time. But RBA looking to raise rates by 25 basis points. And then go into RBNZ. Also, they're expected to raise rates by 25 basis points. If we see these central banks continue to tighten and continue to raise rates, is the Fed going to do the same thing coming in May? Well, it looks like right now that probability is yes, that the Fed might increase another 25 basis points. I was able to get caught up on a ton of podcasts and content this weekend, and we have a really interesting scenario. We saw a bit of a melt up for Q1. The markets finished on a good positive track last week, which helped them stay positive for the year. Thus far, year to date, the Qs are up over 20%, or tech is up over 20%, which is arguing the question: Are we in a bull market now for tech? Are we in a technology growth related bull market once again? One thing to note and take away from that is the Qs are sitting at 319. Okay, from the year, pretty much starting at the year's low. We're up. There's the low. We're up around at 22 to 23%. If we're in a bull market, great. The one thing that doesn't match is the actual market volume and breadth, which means that we have had an absence of sellers. So, there's not a lot of volume that's driving this market up. I think that tech is certainly more vulnerable to, if we don't break this high, then this was a nice little Q1 move, but we might still fail at this 330 level on the Qs and still fade back down. But I'm not sure. I mean, this really was all kind of dictated by the Fed. When the Fed said, here we are with a backstop, here we are, increasing the balance sheet once again, I think the market started to price in that it's a switch back into growth. It's a switch back into tech is going to be okay. And also considering how beat down tech was in 2022, it really offered kind of the best Q1 bargain. So I'm watching tech very closely. I mean, I don't think this is just full on raging bull market. I think that we're going to have some indecision to navigate. But at the same time, I mean, if we get a dip, I'd be pretty interested in buying the dip. I mean, if we have this low, if we have a higher low, guess what? I mean, the stock market trends are pretty simple. If we have a pullback and it has a higher low, then guess what? I want to be in on that trade, because if we do come after that high from August of last year, then let's go. Let's get some good runs, And that means that also individually, there's a lot of stocks that are still offering up some pretty good opportunities. We've had big tech lead the way. I mean, if you take a look at Apple, I decided to chart alarm go off this morning on Apple at 165. So we're trading at 165 on Apple. We're coming back up to some channel resistance. Now, again, if this technically holds, resistance, right there is a great point. Apple, a breakout, it's possible, or a rejection, also very possible. So I think the Apple movement could also give us a big run on the Qs. How does tech fare this week? How does tech fare to kick off this first part of Q2? If Apple starts to show signs of rejection, I'm sure the Qs will start to sink a little bit as well, right? And same thing goes for your Metas. Meta's up to 209. Microsoft had a good run. We're up to 287. So is there going to be a little bit of a pause or a fade? We'll find out. Okay, I've got some credit spreads out here. I'm looking to get, I've got to get pretty active on some of these trades. Last week had some good profit, XOM, which fortunately I was able to get out of XOM with a full profit. I had a 113 by 117 bear call spread. We closed last week at 110 or just below that. So that's good, because that would have been, that was full profit here. And we gapped higher into, now we're at 115. So that credit spread to be upside down. So fortunately that was an expiration on Friday. And I'm not worried about this gap right now. But I will be watching, because, does XOM with this move on oil cuts, is this move going to run all the way to 120 and help a stock like XOM and oil keeps running? Or is this going to be a push up into resistance and then we end up gapping back down and filling that? Not sure, but we'll have to watch price action. Okay, what's up, Charles? How are you? Good morning, Don. Morning, Robert. Okay, what's up, Bill? Okay. So as a kickoff here, let's look at the SPY. SPY's at 409. Look at the Qs. We're trading at 319. The DIA, we're trading at 334. So for the most part, the market was pretty excited about the Fed little backstop situation. This isn't the last we've heard about bank drama. Everything going on between Silicon Valley Bank, Signature Bank, First Republic. There's other regional banks that are probably going to be on the chopping block, or have to have some type of concentration where there's going to have to be a liquidity injection somewhere, or they're just going to be absorbed by somebody else. Everything going on with Credit Suisse being absorbed and bought out by UBS. That's all changing. UBS is probably announcing job cuts here in the next couple of months. So, anywho, a lot to digest, right? But this is what we're going to be navigating. I think the good thing is we've gotten through Q1. Typically, April, May, going into the summer, this pre-summer push is upon us. I think as long as we can kind of maintain where the Fed doesn't hurt the expectations, maybe a 25 basis points hike for May is not a bad thing. But more importantly is how do we look at the end of the year? If the Fed raises rates, where are we looking for December? Again, the market is anticipating that even if they raise rates again in May, this would be our peak, this would be our pause, and then we're still cutting rates by the end of the year. That is the market expectation. So going into December, 4.5 to 4.75, 4.25 to 4.5, that is a 0.5 to 0.75 expected rate cut by the end of the year. So it's hike, right? We hiked in what? I'm trying to think. Do we hike in January? Do we have a rate decision in January? I know we raised in February. I think it was February, March. We raised February and March. Now we're looking to raise again in May. So if we have a raise in May and then pause, and then looking for cuts November, December of later this year, right? So and why would the Fed start cutting rates? I mean, this is one thing to note. Why would the Fed start cutting rates? There's one secret word that I'm looking for. If anyone knows it, why would the Fed start cutting rates going into the end of the year? Let's have a little fun. I'm going to type in a letter. You try to fill in the word for me. Type in a letter. That's not a letter. Right here. What's the word? There. No. Start. I gave you the first letter. Yes. Yes. If this is what the market is going to experience, if this is what the economy is going to experience, that is why the Fed would start cutting rates. Okay? Every business cycle that we have seen, when we have these expansion cycles, peaks, contraction cycles, troughs, okay, when we're coming out of this, where we've clearly had a correction, a contraction like we had in 2022, if we're looking to show some type of bottom now, it could obviously get worse, right? But 2022, I mean, we kind of came out of 2022 into this low point, and it's not like we're going into a full-on expansion, but if we're going to have a recession and the Fed is actually going to acknowledge it, then guess what? They will start cutting rates, because it's I mean that term is enough to ruin consumer spending and ruin consumption and hurt optimism, and so the Fed becomes a little bit more accommodative. Now, what's going to be interesting, of course, with our tight labor market is, do we have this odd recession where we still have tons of jobs available, or do we start to see more and more cuts happening? I mean, we're seeing more cuts. If you're reading headlines out there, tech is still cutting jobs. It's coming into other sectors as well. I mean, financials are certainly in some trouble. I mean, stability right now, like the bank sector, XLF is down a ton. Regional banks are I mean, as far as liquidity and solvency are being questioned right now. The bond market's wild and crazy. So I just think that, we've kind of ignored the true definition of a recession, which is just two contracting GDP quarters, and we've certainly had that. But because we have a tight labor situation, like, oh, there's no recession. But I think if we get into there as we approach, summer and into fall, that's about the only way I can see the Fed stepping in and saying, okay, we're willing to cut rates. And they probably won't say anything. The Fed is going to be very quiet, I think, in 2023. If they're in fact going to cut rates by the end of the year, they're going to be very quiet about it. And the reason why they will be quiet about it is because there's one looming thing: inflation, 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 inflation. That data is super important to see that it has to continue to come down. If this trend on year-over-year inflation does not continue to get better, meaning that we go from 6% to 5.5% or 6% down to 5%. By the end of the year, I mean, I don't know what the Fed projects for inflation, but we might truly be operating in a deflationary environment right now where our real inflation is coming in, month over month at flat levels, 0%. But because we're still lagging with this, maybe it comes down, we're ultimately settle in at that, 4 to 3% level. Now the Fed says 2%. That's what we want, right? Is 2% achievable? Maybe. If we're operating at, negative 2%, that we can bring this back down and then finally find this equilibrium. But I think we're going to have stickier inflation for longer. But if we have job cuts, if we have an overall contraction, I think that we can kind of find this balance. We clearly reached a crazy crescendo of drama and chaos and extremes and irrationality in 2020 and 2021. The market tried to make its best correction in 2022, and I think going into this year, I mean, I think this could be the year of surprises. Maybe the market surprisingly does better than we think. Maybe this is like the fear of missing out type rally where things just go up because it's not as bad as 2022, but it's hard to justify why the markets and the assets would be going higher. And if we go higher, does this lead, is this higher inflation? Does this rally in the markets lead to higher inflation? The Fed's going to talk it down the whole time, right? I mean, there's probably, if the markets rally here, this might make investors happy, but the Fed, if we see stickier inflation, the Fed's going to be upset. So they're going to jawbone, right? And they're going to try to, again, pause rates where we are, keep rates the same, but we're probably at that peak cycle where if we stay at 5%, fine. We stay at 5.25%, fine. But I do not think the Fed can operate above 5% for very long. I don't think that servicing our public debt at 5+% on $6 trillion added to $20-30 trillion is going to be a solution. Now, we have this whole thing with the U.S. with the debt ceiling. It's going to be a political gridlock and a battle back and forth. I mean, I don't want to get into politics. I don't know how it's going to shake out, but July to September is going to be really interesting with the drama that builds up around the debt ceiling. This isn't an election year, but we're going into 2024, which is an election year. So who the heck knows? All I'm saying is buckle up. It's going to be a pretty wild ride, and we'll do our best to make sure that we're following current price. Because if things stay up in this little melt-up environment, so be it. And part of the reason why the market would be excited about this is I think that what the market is sensing and sniffing is that this rate hike cycle is coming to an end. Whether it's now or whether it's May, if the market senses we're pausing, if the market senses we're not bracing for more rate hikes, then that's giving the market something to celebrate. And clearly that's where, we took the end of Q1. We're kicking off right now with a decent start to the week. And we're going to see where prices take us. Okay. There you go, Gary. Yeah, UBS cutting, 30 to 30,000 jobs or so. Yeah, I read like 10 to 30 yesterday. So it's very possible they're cutting jobs, and they're absorbing, a huge balance sheet from Credit Suisse as well, which has been a bank that's in problems for, a decade or more. So anyway, lots of crazy stuff. Okay. So let's get to this real quick. As far as my schedule goes this week, I mentioned this earlier. If you came in and tuned in late, nice to see you here. Thanks for joining in. If you just do me a favor, hit that thumbs up button for me. Let's get as many people watching and thumbs up. Let's get the algorithm saturated with some likes, so it helps the channel grow. Schedule this week. So Monday is business as usual. But I am out Tuesday through Friday, no live sessions. So my flex trading room, my equities on demand, no live trading rooms this week. Why? I'm going to Augusta. So trip to the Masters. I've had the privilege to be able to go. Well, I've had the opportunity to go rather, but I've never taken advantage of it. I've been a PGA member for over 15 years, and that's one amazing perk that Augusta National offers to PGA members is you have complimentary grounds passes. And in 15 years, I've never gone to the Masters, and so I'm gonna make it a point. I've seen enough snow. We just got another 3-4 inches overnight in Utah here. I'm sick of it. I was in Arizona last week. It was nice to see some sun. So I want to see some more of it. I'm going to go check out Augusta. So anyway, we're going to be on, it's going to be Telegram and video updates, which I'll still be in the markets. I'm still bringing my computer with me. I'm still trading, but just no live sessions. Okay. So all week, I mean, we still have some expirations to watch. We still have some trades we'll be taking. But tomorrow's flex. Today we're good for equities on demand, but Tuesday, Wednesday, Thursday, and Friday, I'm out. There will be no YouTube session on Friday. If I do a YouTube video, maybe I can post a video on Friday for a little weekly recap. But I'm just gonna. I just know that schedule wise, it won't really permit me to do any live sessions this week. So this was kind of a improvised move, but turns out that I've got some family that lives close to the golf course in South Carolina. I've got family that's coming down from North Carolina, so I'm gonna end up seeing some family, going to the golf course, and just hopefully seeing some sun and let this snow just pass for another week. I mean, here we are. It's April, and we still have. I mean, I talked to some avid golfers here last week. There's still 50 inches, 55 inches of snow on the golf course this year. So we're not going to play golf in Utah until probably May or June, which is super depressing. And there's only so much longer I want to ski, and I think that ski resorts now are still going to stay open till like the middle or middle of May. So anyway, everybody good on that? So this week's schedule, today business as usual, Tuesday, Wednesday, Thursday, Friday, no live sessions, but I will be active in Telegram. I will be active in providing a few video updates. I'm still going to be trading and watching the markets as usual, but just in between some action at Augusta National. Okay, so that's the schedule for this week. Any other charts you want to take a look at? Let's go to the DXY really quickly. We talked a lot about the Fed this morning. Here's one thing I will say, and this is what we've been talking about all year. Look, if the dollar is going to get weaker, that's a good sign for the stock market. Okay. What's going to be really interesting is, is the U.S. stock market going to perform well along with the European stock market, like the DAX? Is it going to perform well with the Asia stock market, the Japanese stock market? Maybe, maybe a risk-on rally because we have a softer dollar is really the trade-off. If the dollar gets weaker, I get it. If the Fed raises rates, which I think they're going to continue to talk about this pause and talk about, being firm on rates to tackle inflation, they're going to stick to that narrative. But in the background, if the money supply is going up, okay, if the balance sheet is going up, if there is QE, which there totally is, after everything that happened with Silicon Valley, there is QE going on and the market is sensing it. And so, the Fed is limited to their toolkit, right? I mean, they can, increase the balance sheet, decrease the balance sheet, they can raise rates, they can lower rates, and that's all they can do. And what they get a lot of free mileage out of is their commentary. And we've known that for, the last 20 years, but it's been more and more important the last 3, 4, 5 years, especially as we navigated COVID, as we navigated out of COVID, as we've added trillions of dollars to the debt. Now we have a looming debt ceiling crisis, which becomes a political weapon for one side or the other. And there's like the drama is not over. But I'm just saying directionally, if the dollar gets softer, it's easier for stocks to rally. Now, like I said, is it just U.S. markets? Probably not. If we looked at something like the DAX, that should be the European. That's the German market, right? The DAX index. So right here, how's it doing? So the DAX started out with a low in It was just the end of Q3, but since that point, we've rallied quite a bit. The DAX is up off the lows around 46%. Now, again, that is outperforming both the U.S. SPY and the U.S. Qs by a lot. So do we have a movement into non-U.S.? I mean, I looked at this on a higher time frame. This is a structure that I saw right in here. So we're in this kind of critical midpoint. And is there a way for the DAX to go up? I mean, this is kind of nuts, but could the DAX make new highs? Maybe. Or did we put in a low and we have a pullback in here, but we're watching closely? I mean, I would say right now that there is kind of this re-leveraging that's happening, sensing that a lot of these central banks are going to be at the end of these rate hike cycles and lead more into other assets. So I think the stock market could fare pretty well, but a lot of it's going to be hinged on the dollar. If the dollar continues to get softer, I think that bodes well for stocks. So keep an eye on that correlation. And this is good. I mean, even if it feels like a melt up, even if it feels like irrational, it doesn't make any sense. Why would the stock market go up? Look, if the dollar's going down, the stock market's probably going up. That's been a pretty common risk on, risk off theme. If the dollar's getting softer, I think Bitcoin is also going to be another one to keep an eye on. Bitcoin's trading at 28,232 right now. Major resistance ahead at 30K. Okay. But I will say this. Here, I mean, personally, I'd almost rather see Bitcoin do this. I'd like to see it pull back and find some additional support. We have support here. If we find a higher low and then we break through a big level, is going to be 30,000. If Bitcoin breaks above 30,000 and goes, I think we could be on the cusp of another pretty strong bull market. Okay. Now, I mean, call me crazy, but is this possible? Is it possible for Bitcoin to break above 30K and somehow make a run above 68K? It might seem nuts, but it did the same thing over here. We had this high, we had this high, we had a pullback here that was 70 to 80%, and then when we broke, we just made ridiculous runs. Now, why would Bitcoin be this great alternative? Well, it's decentralized, right? It could be the proof of blockchain Web 3.0, the future. It doesn't have anything to do with digital currencies from a fiat system like the dollar, right, or the Chinese yuan, or anything else. And there's still some strong speculation in it, which that strong speculation can get the herd instinct. And again, I'm saying for me personally, I mean, I'm looking at, I mean, this level is not ideal, but if I put some in at 28,000 and I put some back in at 20,000, if we range, I can see this. So we could range, right? We could have a range from 30K to 20K for a while. But I think a big level this year is 30K. If we can break 30,000, we might be off and running for another pretty crazy run. And I certainly would rather be in with some Bitcoin now and looking to add some more and be ready for a breakout of 30 that gets ridiculous. I mean, if we go from 30 to 100, I'm going to feel silly not putting in some more money. I'd say that between current prices, right, 20K lows and 28K current price, and then again at like 3250 to or 32.5 to 35,000 to 40,000, and then from there, let's hope that the next run is 75 to 100. Right? I mean, that just on pure growth alone, and just even if it's speculation, be something pretty exciting. So we might have a surprising run on Bitcoin this year. I just want to get ready for it. But I think 30K is a big level. Okay. So again, tons of stuff to digest. We're just getting started. Q1 was a nice little melt up. We navigated it pretty well with some good profits last couple of weeks, especially. And we're just getting started. So it's Q2 kickoff. Let's see where the markets go. This is an important week. It's a holiday shortened week with Good Friday, but we still have some news. RBA, RBNZ, CAD news for employment, non-farm payroll on Friday. I wish I was with you for a bunch of live sessions, but I'm not. We'll continue the live sessions next week. But again, we can prep all that today for Monday and just get ready. Okay. Ethereum too. Yeah, I mean, possibly. I mean, if I think Ethereum, we still have the yearly pivot here at 19.9. Our big level of past support is around 21.6, so it's 21.60. So I'd say with Ethereum, if we make a run above 2,200, then sure. I mean, it kind of follows the same path. But I would say Bitcoin is probably going to lead the way. If Bitcoin leads the way greater than 30, I think that essentially every crypto, well, every major crypto that I think is worth trading, would be following along, and kind of Bitcoin's dominance could drag it up. So we can keep an eye on coin market cap and see where things are at. But there's a big run on Ethereum. We break above 2,200. There's room up to 3,600. We have our highs up here that I'd certainly be watching. But like I said, all that to me would be, where would I get in on Ethereum? Well, if Bitcoin breaks above 30K, we go from 30 to possibly 70. And that sounds nuts, but that's where the highs are. So could Ethereum do the same thing and break above 22 and then get back up to 4 or 5,000? Sure, and then some. So we've seen all sorts of crazy stuff. I did measure out some movements here. If we have this calculated, if we take out this high, looking at some wave cycles. If we have wave 1, 2, 3, 4, 5, that gets us to new highs around 7,000. So there's some analysis we can do to it, but I think the proof is we got to break this past resistance here. This past support become resistance. And for Bitcoin, it's got to be 30K. All right. So anyway, all that stuff and more coming at you in the markets. And I'll do my best to deliver, all the commentary on Mondays and Fridays for the Pulver Report, and in the trading rooms, of course, trying to navigate this live with everybody. And we'll do our best. Okay, it's 10 o'clock. I'm going to switch gears here to Equities on Demand for class. Thanks for being with me today. This week, I'm also going to be, well, it's today really, I'm in webinars for a new course launch called Equalizer Pro. Really excited about it. I shared this last week with some of my Masterflex students. Results are pretty outstanding. I had 4 completely different strategies within this course. 4 completely different strategies, all produce really nice winners. And essentially, it's a strategy that I'm running for full auto. The big difference, and I've never built a system like this before, I have a sell-only direction, and then I have a buy only direction. So I'm running this on 2 accounts, buy only and sell only, and I let the system do what it's good at. I let it manage the buy trades to the best of its ability. I let it manage sell trades to the best of the ability. It trades equilibrium as well as trends. So a trend buy only, trend sell only, and have profits as a net result. I mean, 55,000 pips just last year, 34,000 pips last year, 32,000 pips last year, 41,000 pips last year. Now, granted, this is on potentially 6 entries per currency pair. This does have stop losses. This does go after, take profits that are bigger. This is a hedged based system. So, I'm a US trader. I can't trade a hedged account. But what I can do is I can have one account that's buy only, one account that's sell only, and all 4 strategies, what they're good at, they're good at managing those single direction deployments. So pretty excited about this overall. So I'll be sharing that today in a couple of webinars. I'm in the 11 a.m., 4 p.m., and 7 p.m. webinars here at Market Traders Institute. So good stuff. All right, traders, I'm going to let you go for today. Equity Design Demand students, I'll see you in the trading rooms for Smart Trader. Let's switch gears. And that's it. Remember, I'm just going to type in the notes here for YouTube. Thanks for joining today. Remember this week's schedule, Telegram, and video updates only for Flex and EOD trading rooms. Because I'm going to Augusta. Okay, all right, traders. I'll see you in the trading rooms, and have a great week. I'll be in Telegram. I'll be doing some videos. My YouTube session, I won't do a live session on Friday, but I might just record a video and post it. See how things are shaping up by Thursday, Friday. I might post a video late on Thursday night, record it, and then just post it on Friday morning, so you can have something to digest for weekly outlook or weekly recap. But thanks for being with me today, per usual. Okay, thanks everybody. Take care. Have a great week, and I'll see you soon. Thanks. Bye.